I want to break what I'm about to say into two components, and I'm not going to talk about one of them because it's not appropriate for this episode at all.
All right.
All right, so trusts and structures, right? Entities, the whole conversation around this. First off, is a lot of the decisions people make in property around structures is actually for borrowing power. So I'm just going to go and say, we're not going to talk about that at all. This isn't a borrowing power episode. Definitely speak to your broker and accountant if you are looking for different ways to manipulate your borrowing power. Whole different game.
Completely.
From a tax perspective, though, your structures and setup is massively, massively important. And I'll go through a few of these here. You can't negative gear a property that's in a trust.
Impossible.
You can only negative gear a property that's in your own name. You don't get tax-free growth on properties in a trust. It only works if it's your principal place of residence.
Which is in your own name.
Yeah, so can you imagine if you're a really high-income person and you buy a property in a trust expecting to negative gear it and then realize you can't, how much of a disappointment that may be?
Totally, dude. It's like, but it's funny. I've called myself out on this, listening to people around like these tax ideas and these tax concepts, only for me to go down a rabbit hole. And then like this one sentence is like, it does not apply if you have it in a trust. And I'm like, oh, okay, cool. Like this is just different things. It plays games differently.
Completely. And there's company structures as well, right? This is a whole different thing again. And I'll just go into this other one that's really interesting. In New South Wales, there's certain rules around buying property in a company. And it's very different than buying one in your personal name. And depending on what you're actually getting up to, you may want to take advantage of that.
Totally. And first buying a trust as well. Land tax is fundamentally different in New South Wales in trust versus a company.
Completely. So again, it's like knowing the dynamics of these structures, not only from like, okay, if I buy a property in a company versus I buy one in a trust, and there's varieties of trusts, whether it's bare trust, unit trust, discretionary trusts. Yeah. And if there's a company with that, is it a corporate trustee? You know, like these are all the important questions to come through. But then all of that is individualized to the states.
Yep.
So a corporate trust in Victoria is differently treated than one that maybe is in New South Wales. And they might be the same. I don't know off the top of my head, but you get the idea. But all of this massively affects tax in a huge way. So knowing the rules of this and the strategy that it's appropriate for you is a hugely important conversation to have with your accountant, because all of this can make a massive difference to where you end up and the things you have to do.
Have you ever looked at moving things around in different structures after you made decisions like a year or two ago? You'd be like, man, if only I put it in a different structure.
All right, you want to go there? We'll go there. Yeah, so I definitely made mistakes here. And I mean, I will only know down the road, but something that I did that I look back on and gone, probably better ways to do it with what's unfolded. I understood that there's basically a way to play the game of property in which if you buy properties in different states, what you can do is actually remain under the land tax threshold in every state. You can grow a substantial portfolio without having to incur a bigger cost.
Yep.
So I was all over understanding that probably not a good idea in my case and what I want to achieve, that if I just buy properties in Southeast Melbourne, that's going to end up in a very strong tax situation versus spreading out some of the risk. There's also like geo risk I wasn't a fan of as well, right? I was like, you never know what any state is going to do, so I don't want to be all in one state. And you only have to look at what's gone on recently with Queensland and some of their tax decisions and things going through government to go, I probably wouldn't want to have all my property just there.
Completely.
Or Victoria with some of their standards and the way they do things, but we'll leave that out of it. So that I was all over. The thing I was not necessarily aware of or all over is that I put a lot of property in my personal name to start with. So I very much limited my ability to manipulate distributions, and I use that word selectively there, or to add other people to trusts and do other things in that arena that would be favorable for my tax situation. I'm going to have to say this again. That is not tax advice. That is in my personal circumstances, and it may not be suitable for other people, but those impacts have definitely limited my ability to make certain moves later on. Not that I can't make changes to these, it's just expensive.
Very expensive.
Yeah. So, for example, I have a property right now that in hindsight, I should have, in my situation, put into a different structure. I didn't. If I wanted to move that property today into another structure, I would have to pay stamp duty again. And then I would also have to pay capital gains on the property so far. Now, keep in mind, I have to pay capital gains on it at some point anyway. So these aren't the only real cost here is the stamp duty again.
To move it. Yep.
Yeah, but it's making basically my deferred tax strategy into a tax payable strategy now.
Yep.
And that has an implication that I am not a fan of, just not a fan of. So there's other things I'm now doing to negate the impacts of that.
I did something similar, but on the other side. So I bought a property that I knew I had to renovate this property. And we spent I think it was about 32 grand renovating this thing. Put it into a trust with a corporate trustee, and then did the renovation only after for me to go, oh, wait, it's not in my personal name. I'm like, I can't offset my income.
So you would have carry forward losses?
Yeah. So it's like, so it's not the end of the world. It's just, I'm like, well, if I swapped these two assets and I did the one that I was in my personal name for a reno and the other one that I'm not doing a reno on in a trust, I'm like, it would have been a better situation short term.
Can we go there a little bit?
Of course we can.
All right. So just to explain what is referenced there is if you have a property that's in your personal name and you take a loss, you can negative gear it.
Okay.
That is the strategy people would use. Not financial advice, once again. If you have a property in a trust that is negative geared, you don't get to offset that loss against the income. You actually take it as a loss against the future profitability of the trust.
Yep.
Which means you basically have this loss locked up in the trust and you have to wait for profits to be created to negate it. Now, you do get it. It's just, it's like how we tax deferred strategy on paying it? Well, this is the government doing it the other way.
Completely. It's like, But it comes back to the point of what is the long game, which is where my mind always comes back to. So I'm like, frustrating in the scenario of then and there at the end of the financial year of me having this conversation with the accountant and him going, yeah, just so you know, if that was in your personal name, this would have happened. And I'm like, okay, shit, I can't do anything now, but just being aware of it.
Well, this is why I think you've got to have an accountant who's into property. The nuances of this make such a difference. And I like the idea that they've put the time in to solve this for themselves because it was important for their own wealth.
Yeah.
That where I'm not the guinea pig, right? It's already been tried and tested for themselves and others. I'm just more leveraging off a system that can work there.
Yeah. So somebody who's already aware of all the nuts and bolts and how it works.
I was quite surprised by this as well. As you get deeper into this game and you do develop the use of different structures and entities, even where you park your cash in different offsets can make a difference to yourself. So I'll go through this as an example, and this won't apply to all people, but just an idea to talk with your advisors about. Let's say you've got $100,000 and you've got two properties, one's in a trust and one is not in your personal name. If you set your spare cash in the offset account of the property that's in a trust, you're kind of making that trust more profitable so that you wouldn't necessarily have losses in it in that way. So in your circumstance here, Grant, you might maybe be better off looking at the use of offset accounts to make that work for you in a more tax favorable scenario as well.
It's exactly what I did.
Interesting.
But it wasn't 100 grand, it was 75. All right, fellow property investor. If you loved the value from this short video and wanted to know more about how you can win at property investing, check out the full episode by clicking the link on your screen or in the description right now. Alternatively, click subscribe and you'll never miss another one of these videos.